Good afternoon, everybody. Welcome back to another Watermark Wire. My name is Jack Grabarczyk. I am a current Watermark intern and a senior at Wofford College. And today I'll be walking y'all through the rise of alternative acquirers. So kind of what we've seen recently is that there's been like the shift in buyer types rather than just private equity. And this buyer market has really kind of expanded and created a little bit more competition. And so 10 years ago, if you're selling a $20 million business, odds are you probably got a knock on the door from a private equity company. Nowadays, that knock could be from young, hungry MBA grad running a search fund, a family office thinking in generations, or an independent sponsor syndicating equity. And looking at the changing face of buyers of who's closing in 2025, this data is from Axial Markets, so it represents their clientele base rather than the USA M&A market as a whole, but it still represents this significant shift that private equity is facing more competition and that there's a rise of alternative buyers. So in 2021, we can see that obviously private equity and independent sponsors really dominated this market. And shifting over to 2025, we see that this market has really kind of evened out with family offices now taking a slight majority. And so what this is doing is creating a lot more complexity for sellers with understanding who are these new buyers that are at the table and how to understand and compare each offer. So starting off with independent sponsors, these buyers are typically deal by deal and relationship driven. So they don't really have this committed fund that a lot of other financial buyers have. So they don't really have this use it or lose it clock. And they raise equity only when the deal is worth chasing. And so many of these buyers are former CEOs and founders who know exactly what to buy and how to grow it. And these deals come from tight personal networks and relationships rather than these crowded auctions that a lot of these other financial buyers are competing in. They prioritize cultural fit, continuity, and this oftentimes makes them a natural favorite for founder-led businesses. Then moving into family offices, these buyers are the patient capitalists. So they are investing their own family's capital, enabling long-term strategies with slight exit pressures, a lot less than other financial buyers. And they prioritize long-term resilient investments, and they want that predictable cash flow and stability rather than the short-term wins. So according to Axial, family offices have surged 31% globally since 2019. And as we saw earlier, they now account for the majority of these different financial classes of buyers. And this is made up of 3,400 SFOs, which are single family offices, and so they manage one family's wealth, and 1,500 MFOs, which are multifamily offices, and they manage multiple families' wealth with these institutional level services. Then lastly, going to search funds, this buyer is like the rise of the CEO in waiting. So they have this fundless operation backed by investors to acquire and operate a single business. So differing from an independent sponsor, they really just want to run and acquire one single business rather than building this portfolio. So oftentimes this leads to smooth leadership transitions while preserving company culture, and it provides this unique opportunity for sellers without a direct heir to their business because they're essentially handing over the keys to the new CEO. And with this, it preserves company culture while driving growth. So it provides this balance of stability with like this fresh mindset and fresh growth outlook. And these searchers are often highly selective, reviewing hundreds of opportunities before acquiring and pulling the trigger. And going over the buyer landscape as a whole, starting with speed and flexibility, independent sponsors are very flexible. They oftentimes have minority investment, and so they can create these really creative structures. Then family offices, they're also very flexible. They have the fewer fund mandates since they're running their own capital, and they have this long-term outlook. And search funds, they have this moderate flexibility because it's the one guy really wanting to buy and run the business. And so they really have the thorough search and the single focus on the business. And then with private equity, it's a very structure-driven process, and so it has moderate flexibility and moderate speed. And then going into strategy, independent sponsors are very opportunistic. They only really go for an acquisition when the right one comes along. And they tend to build these companies through strategic add-ons and traditional growth. In family offices, they often do direct deals and co-investments with high net worth individuals or private equity firm co-investments, and they oftentimes go for the long hold growth. And then search funds are the guys that just want to acquire and run one company and grow it long term. In private equity, they do a lot of the traditional growth method, but they also want to do the buy and build through add-ons and acquisitions. With risks, independent sponsors have less committed capital, so the deals can be at risk if they can't find the right capital allocation. And then family offices can be sometimes a little bit more conservative on valuation and deal terms, which could create a little bit of a higher risk. And then search funds, since it's really just handing the keys over to the next CEO, oftentimes it can be very dependent on operator skill, and that creates that transition risk. And then with private equity, there's a lot of exit and liquidity pressures, oftentimes requiring CVs or CV squared. And the seller appeal, independent sponsors are very flexible and they're often very founder friendly. And then family offices, they prioritize the legacy, the culture, continuity, and they have that long-term investment. With search funds acting as successor CEOs, preserving the company culture while bringing that fresh growth mindset. Private equity firms, very professional, financial first, and exit oriented. And so this is exactly where Watermark can help cut through the noise. We use the M&A bridge with the preparation, transaction, and integration phase. Starting with the preparation phase, the buyer list is where we help identify these new classes of financial buyers. With search funds, family offices, independent sponsors, as well as private equity and strategic buyers as well. And then in the transaction phase, we'll approach these buyers and figure out what kind of their priorities are and help align them with the seller's goals. And this would allow for smoother integration process and an overall more successful M&A. And I hope you guys found this video very insightful, and thank you guys for watching. If you have any questions, please don't hesitate to reach out or go to our website. Thank you all.